Let's talk a little bit before we go further about polling procedures. If you can go onto the SFIG Vegas app, which you can download, it's called the 10D Hub on the Apple or Android store. Search for SFIG Vegas, use your IMN login credentials, select menu, find our session, and our polls will be listed there. And we're going to have some polling questions coming up very quickly, so if you've got your app, please open it up and check out the polling questions. We're going to start with RMBS as a main topic, and if we could switch to our first polling question, that would be fantastic. There we go, coming up. Which Reg AB 2 requirements would you find to be most beneficial if they were applied to RMBS 144A transactions? 1, asset level data. 2, financial condition of rep and warranty providers if there's a material impact on performance. 3, inclusion of asset representations reviewer. 4, provisions enhancing investor communications. And 5, disclosure of retained interest. Wow, Jack, I don't think I've ever seen a polling result this one-sided before.
Everyone agrees on this.
All right, man.
This was 100% expected across the board here. I would have expected this. I don't know if we want to leave some more time, but I can get started.
Well, why don't you talk a little about that in the context of some of the things you're prepared to talk about? Almost all of our RSBS transactions since the credit crisis have been 144A deals, so there's actually very little experience out there in the RMBS markets with Reg AB compliant deals. But the industry's already done a huge amount to improve transparency and disclosure that's not through the SEC registration process. So I was wondering if you could talk us through how the industry has addressed already many of the requirements of Reg AB 2 voluntarily through RMBS 2.0 and 3.0.
I can definitely do that.
That would be awesome.
Thank you, Charlie. Thanks, everybody, for coming. I don't know if we'll switch back from this polling. It looks like we've had...
We will.
Yes. But I can go to the slides. But actually, just leading off, we can start there. The main concept that I wanted to talk about with everyone today is what you just led into, Charlie, is the industry has done a lot to address some of the Reg AB disclosure and transparency requirements already. What I present here on the first slide is just sort of a visual on what objectives have really been addressed so far and what have been sort of not neglected but not fully incorporated into the process yet. And I think the main thing to think about is the industry has somewhat self-regulated on this issue across a number of these categories. You'll see them on the right-hand side here. And that's through initiatives like SFIG and what they do for various work streams, and issuers have had to do it themselves as well as they've been marketing to investors that post-crisis have had the same sort of concerns that the regulation has tried to address. So there has been some self-regulation. Myself, us as a rating agency, we also have a culture, and we want to provide transparency and disclosure on the transactions that we rate. We happen to be privy to a lot of information that investors are not to be able to do the work that we do. And so some of those items remain on the left side. So I know it was probably only a small number of people who contributed to the poll, but I would have expected, frankly, that asset level disclosures, for example, are one of the areas where there hasn't been a lot of standardization across RMBS issuers in terms of what's provided. We happen to be in the position, because of what we have to do for the market as a rating agency, to get a lot of that disclosure. I know some issuers provide investor tapes when they're out marketing, but the standardization across those is not very great. Whereas Reg AB 2, requires a whole set of disclosures at the loan level for issuers to put out there. SFIG does have some work streams that I know they're working on to try to set out a standardized approach. It remains to be seen how or whether that'll be adopted over time. I won't spend as much time, frankly, on a lot of these so that we can move on a little bit. But in terms of, on the right-hand side, the things that the industry has come up with and done on their own are things that are initiatives that SFIG has had. So I think originator disclosures, it's not really a big SFIG approach. I'd say generally you'd like some transaction participant disclosure, but it's something that was in Reg AB 2. I have a couple listed on here that I have in parentheses: rep warranty and enforcement framework. This was a big initiative of SFIG. This was a big concept that investors had, frankly, pushed back on post-crisis about what are we doing to address issues of enforcement. Even if the scope of representation and warranties that are provided are robust, you need a process for being able to identify breaches and have somebody actually repurchase them. That needs to be actionable. So there were a number of Reg AB 2 initiatives that were aligned as well, related to providing information about the financial condition of the repurchase provider. A large factor of this was being able to have an asset representations reviewer, somebody who is, an independent party that's put in place up front to be able to take on this responsibility of being able to identify a breach if necessary, and then having dispute resolution. So many transactions that we see in RMBS now have binding arbitration or some level of arbitration back and forth when a decision has been rendered to move on. Just briefly hitting on these, and I'll have some visual aids afterwards. Disclosures of transaction party economic interests. This happens a little bit. There are requirements for risk retention, certainly, that are outside of Reg AB 2, and so there are requirements for that. There's disclosure. There's been a little light on the disclosure related to, if there are servicer retained interest or any other originator retained interest, that those aren't generally required, though some do voluntarily do that. Bondholder communication is just one that I'll mention that SFIG has had good initiatives on trying to get implemented. It's also one where the issuers themselves and RMBS generally 2.0, 3.0 hasn't adopted yet. There hasn't been a lot of heavy adoption in, say, prime or non-prime transactions post-crisis to employ a lot of efforts to allow for bondholders to communicate against each other. And then I've added one last thing that I'll just touch on at the very end of the slide, TPR diligence. This is outside of Reg AB 2, but part of CRA reform, that there are narratives and diligence, third-party loan-level diligence disclosures that happen with these transactions. There's a lot of information that's actually available. I'm not sure how much they're sort of accessed by the investing community, but I would like to just make it available for everybody to make sure everybody's aware.
I just think this is really interesting to look at it sort of laid out like this, because the whole idea for the asset representations reviewer and the dispute resolution framework really grew out of the RMBS experience in the credit crisis, post-credit crisis, the industry's response to the things that happened in the credit crisis, and now we have an asset class that, at least at the moment, is almost purely 144A. So everyone else now in the regulatory response to the crisis has to comply with these things in a very detailed manner, and yet RMBS is still doing it voluntarily. Some might argue that's a little bit backwards, but
I suppose I would agree with you. And in fact, even within RMBS, it is voluntary, so issuers do have the choice to do it. And we've commented on this in our pre-sale analysis that we've done for RMBS, but a lot of the adoption came through sort of the first issuers post-crisis, so looking to get investors back in the market. So we see a lot of adoption of that concept in the prime RMBS space, where arguably you'd expect to have less issues coming up because a lot of the automatic triggers come from delinquency on a loan. You'd expect lower delinquency on a prime pool, whereas in non-prime issuance now, there tends to not be as strong of a concept of an independent reviewer. So it's
right.
Interesting that it was left open voluntarily.
Yeah, and you think about autos, right? I mean, autos are the biggest asset class on the public markets, and they have to do all of this, and there's virtually never any rep and warranty repurchase, and yet they have everything embedded in there. I noticed. You want to keep going?
Yeah, I can flip through these pretty quickly so that we can get on to some normal stuff. Originator contribution, I just wanted to go through each one of these concepts individually. There's a requirement for Reg AB 2. This one's pretty simple. You just want to know who the contributors are in RMBS. Frankly, a lot of the issuance comes through conduits, so there's heavy originator contribution. I have here a snapshot from one of our pre-sales, but both issuers and rating agencies tend to provide this information in some of their documentation, pro-subs, and like I said, our pre-sale analysis. Again, a lot of the things where it's been voluntary adoption, the issue is not that it's not been adopted, it's that there's not a lot of standardization.
Right.
And so some issuers will only provide originator information at a 5% level. Anybody below that is sort of clubbed together. In this particular example, it happened to be somebody who actually does provide every single originator. Some only do it at a 10% level. So just a snapshot to provide a visual aid for that. I think I'd move on to the next slide. And this, I think, is the most interesting, or it has been from an SFIG standpoint. I don't even know if anybody can read this, but the reps and warranties. So I mentioned there were three sort of conceptual items in Reg AB2 that are addressed from rep and warranty and enforcement framework. Essentially what this is getting at is that there's been a lot of time spent in the industry from SFIG, from the issuer side, to try to address these things. We just talked about it, Charlie. We have adopted, as part of our pre-sale methodology, some of these snapshots that I see here, that I show here. Again, not sure if you can see it, but essentially you want to break out the entire enforcement framework. So if you think about reps and warranties, a lot of times you'll think about just the scope of the reps, whether there are fraud reps or originator reps made for loan, on a loan level basis. There is some variability among those, but generally everybody tends to make the same types of reps. Outside of that, though, it really comes down to a weakest link approach in your framework. If you have a originator who's not very creditworthy, then it matters less how much enforcement framework you put up against that, because they may not be able to purchase the loans at the time when something comes up. The flip side is true as well. If you have a very creditworthy person and you have automatic reviews come up, but you have no reviewer in place, or if the reviewer is frankly one of the rep providers, then there's an incentive to just push down on repurchases at that level. And so we tend to provide this type of transparency. Issuers provide it as well in their prospectuses, though sort of long form paragraph style.
Ready to move on?
I'm ready to move on.
Awesome.
I'm trying to save you some time and get
that button clicking is really, really hard.
All right, fair enough.
Times.
There are requirements in Reg AB2 as well that revolve around prospectus summary information. These typically relate to disclosure of underwriters' guidelines. This has become very important as the market has now grown outside of prime jumbo, where it is important to have strong underwriting guidelines, of course, but we don't see a lot of variability in there. There's a lot of standardization around what full documentation means, and the borrowers tend to be very highly creditworthy. Outside of that, though, in the space that we consider or call non-prime, which is what it sounds like, it's everything that's not prime. You can imagine that's a very wide world. And so disclosures around what underwriting guidelines are allowed in those transactions or for that issuer become very important. I'd say the adoption of a type of disclosure has been okay among issuers that operate in this space. There's a small example in the top right that you can see. There are discussions about underwriting guidelines in a lot of these transactions. I think Reg AB2 looks for sort of matrices of guidelines to be disclosed, and some originators might consider that to be secret sauce, and so they can voluntarily decide whether to disclose that information or not, or ultimately at what detail they disclose it. On the left-hand side, another part of this prospective summary disclosure requirement is related to exceptions to those underwriting guidelines. Again, lack of standardization, although there tends to be disclosure at some level. In this case, you do have issuers that are actually disclosing at a loan level the exceptions to which guideline and the amount they see. I'm not sure if everybody's aware, again, we as a rating agency do tend to get more granular information than this, or we certainly do get more granular information than this. We also have the opportunity to go back and forth, so if you're sitting out in the audience as an investor thinking about it, I think this is a step in the right direction in terms of disclosure. Frankly, this is a snapshot from one transaction. I think this disclosure in this transaction probably went on for pages and pages, and so there is a little bit of drinking from a hot fire hose in terms of how much information you want, but they're starting to provide this information. And then we tend to as well list this information out in our pre-sales and try to put it in a version that's digestible from an investor perspective.
Next slide.
Yes, please.
All right.
Last slide. This follows from that. So talking about exceptions to guidelines, this is just a quick snapshot from a transaction. This is related to Rule 15 GA2. These are requirements where there is third-party diligence done on a transaction, especially if it's considered for our analysis in a transaction, which across all RMBS our methodology requires that for standard forward RMBS, that there's loan level diligence. these forms are actually outside of Reg B2. This is required to be public even for 144A deals, and they are published typically to Edgar prior to marketing of the transaction. And in addition to that, we, and I believe the other rating agencies as well, publish this as part of our packet. So you can actually go onto our website and pull these up, and what these are is a narrative disclosure of the scope of review that was provided by the diligence provider, the exception rates that are listed there, and then a detailed discussion of the issues that came up. And so when, in this example, again, you probably can't see it, but compliance result summary, they're actually listing out the reasons why certain loans were clubbed together and made to be exceptions to the originator's guidelines, or in this case, regulatory compliance.
So big picture, I mean, this is a requirement that applies to all deals, but big picture, what would be required, again, maybe just as a matter of summary, in a registered public RMBS deal, maybe we'll see one again sometime soon, that's not currently addressed in a 144A deal, just very quickly, big bullet points.
I'd say, look, the asset level disclosure is probably the biggest one.
Right.
That would be a material change to, I think, what issuers are doing today. There's just no standardization among issuers of what they provide. Frankly, even to the rating agencies, there's some standardization, but we'll frequently ask for additional information. Outside of that, there have been, removals of some exceptions to financial counterparty disclosures if they had a rating that's been removed. Some information about modification of assets related to the transaction that's generally, it is addressed somewhat, but not to the extent that's looked at for Reg AB2. And I would say also bondholder communication, even though it's been addressed by SFIG, there's been no real uptake in actual RMBS.
You mentioned standardization. Again, sort of a recap. What RMBS 3.0 concepts have been widely standardized and which are still showing significant variation in their adoption and implementation?
Sure. I think due diligence best practices have been pretty widely adopted. The scope of diligence has been generally well adopted across RMBS issuers. There's not a lot of change to that. I mentioned the scope of the representations and warranties that are provided back to a previously, and I won't mention the name of the previous industry group, but there was,
the group that shall not be named.
The group that shall not be named there was a standardization of scope there. I think those are broadly still followed today among issuers. Outside of that, there's sort of wide variation.
Where are we still seeing issuers testing out RMBS 3.0 best practices?
I'm glad you asked. I think the biggest one. I think the biggest one is rep warranty and enforcement. We're seeing across the board within certain sectors and then outside of sectors, prime to non-prime, for example. I mean, this is a place where it's understandable, right? If you're putting your money on the line, on one hand, you want to be in control of what that framework looks like, and so there's sort of endless variations to how you can do this, whether you want an independent reviewer or not, whether you want to have an automatic review or not, or what level of automatic review you want to have it, whether you as a sponsor of the transaction are making the reps directly or you're passing them through from the underlying originators. And this is why we have this disclosure in our pre-sale, because there's such wide variability and options to sort of pick and choose which pieces you want to have.
Cool. Last but not least, maybe 30 seconds on any predictions about what 2018 might bring us in the RMBS markets?
Around the scope of things, or
whatever you want to talk about is fine with me.
Fair enough.
Whatever you want to predict. How far on a limb do you want to go?
I can do so. I think I know a couple of things I can predict. Look, around the issues that are related to RMBS 3.0, I think one of the topics that continues to come up, and I think we will see it now, and it's related to, frankly, how volumes have picked up over the last 12 months, there's more and more discussions around issuers taking up a sampling approach to diligence prior to probably 6 or 12 months ago. Almost everyone in the space was reviewing every single loan that was going into securitization, having that reviewed by an independent third party. It's not a tenable approach to do that when transactions get much larger or there are more frequent transactions. There's going to have to be some level of sampling, so I think we will see that. We've started to see that on some issuers already. I don't know if we'll see coalescing around a rep warranty and enforcement framework. I think we're seeing some testing around servicing fees, whether or not those want to be static fees or whether there's sort of fee for service. We're seeing that approach come out. And I think generally in 2018, we're just expecting a lot more transactions. New entrants are going to want to try things their own way. So more of the same in terms of variability.
Awesome. To be seen. Well, thanks very much.
Sure.
Let's move on to marketplace lending. We're going to divide this into two pieces. First, TJ is going to talk to us some about the recent SFIG green paper on marketplace lending disclosure, and then we're going to move on to sort of some practical implications. Why don't we go to the next audience polling question, if we could, please. What is your primary source of marketplace lending performance data? 1, marketplace lending data platforms such as DV01 or PeerIQ. 2, Bloomberg. 3, Intex. 4, direct from the issuer. 5, trustee or other sources. Maybe we only have 3 people answering. I don't know. But it's probably 2 to 1 direct from the issuer versus Bloomberg, and Index obviously should be Intex. There was a typo somewhere along the way there. TJ, why don't you tell us a little bit about the third edition of the Marketplace Lending Best Practices Green Paper? If we could move on back to the slides. Can you tell us a little bit about that report, both about its contents and all the process that led to its development?
Sure. First of all, I think 2 things to know. This was a green paper that SFIG published just last week, so it is available on the SFIG website. Another important thing to know is that unless you have green paper in your printer, it will not print out as a green paper. But you can get copies. I know Christy Leo is floating around and some of the other investor relations people, so they actually have copies on green paper. So maybe I should take a step back and kind of talk a little bit about what led us to this green paper. And back in August 2015, SFIG formed the Marketplace Lending Committee, which now has 270 individual members representing 90 different member firms. And I think there was a decision at the time that marketplace lending was a growing asset class and that the securitization industry, and SFIG in particular, would be best served if they got ahead of things and started to create their own standards for responsible growth as opposed to leaving it to regulators or legislators or others to kind of chart the path. The committee got together and they decided on 5 primary work streams to pursue: disclosure and reporting, representation of warranty, regulatory, operational considerations, and enforcement. Disclosure and reporting was the first work stream that we delved into in detail. Why choose that first? I think a couple of reasons. Number one, it is investor focused, and SFIG is very much investor focused. And number two, it had the possibility of having the most immediate and direct impact on the securitization market for marketplace loans. With that, we went forward with the disclosure reporting work stream with the goals of standardization, as well as previously stated, the responsible growth of marketplace lending securitization in the market. And the group decided to focus first on consumer loans, unsecured consumer loans, and a couple of reasons for that. One, there really was already a student loan best practices work stream outside of the Marketplace Committee at SFIG, and so we didn't want to duplicate efforts or possibly conflict with efforts there. Also on consumer, unsecured consumer was the largest, and there probably still is the largest market share, at least it was thought of as marketplace lending. And there are 3 components to the SFIG Green Paper: loan level data disclosure, pool level data disclosure, and historical static pool performance and data disclosure. And the idea of the Green Paper is to put forth best practices in each. It's not meant to be hard and fast rules, recognizing that there are different players in the market is still developing, and there needs to be a degree of flexibility within the market. So we did not aim to over-legislate and provide for an exhaustive list of every possible disclosure that could be out there. At the same time, we did want to at least put forth not the minimum standards, but a moderate in-between of things that the market participants thought were helpful disclosure on all 3 levels. And so that's the basis of the paper. Maybe flipping over, Charlie. Slide. And if you look at the paper, the large focus is on loan level data. And I think if you speak to most marketplace lending platforms, they will tell you that transparency is one of their main objectives. I don't know, Rich, you?
Absolutely. Yeah.
And I think that goes back to marketplace roots. It's an asset class that grew out of the financial crisis, and I think there was a desire to make finance and loan financing more transparent. And the marketplace lenders, by and large, did not shy away from moving towards loan level disclosure and really having a lot of disclosure. There's 94 recommended standardized fields across 4 different categories in this green paper.
Yeah, not everybody's doing it though, despite most are disclosing loan level data.
That's right, and we have seen some concerns. Folks worried about re-identification risk in particular at the consumer level, which has been kind of the largest stated concern. But you're right. But nonetheless, I think the majority of the committee did feel that loan level data was important for the industry. And there are kind of 4 different categories amongst those, loan identification, deal information fields. This is pretty basic things like having a loan ID number that you can track through a particular loan throughout its life cycle in an anonymous way. Origination attributes and loan term fields. These are the kind of the nuts and bolts, I'll say, of the loan level data. What's the interest rate? What's the payment frequency? What's the maturity date? Et cetera. Just kind of what are these loans? Underwriting fields, things that speak to the credit quality and other characteristics of the obligor. Both most of the marketplace platforms have their own internal credit grading score as well as using something like FICO. So that would be found in this category. And then ongoing performance attributes fields, which talk about how the loans perform over time, delinquency, defaults, et cetera.
Interesting thing about this, it sounds to me like this is exactly the kind of thing that hypothetically one might see in someday, some version of an asset level data reporting requirement for an SEC registered marketplace loan deal. It's just like a start of that kind of analysis.
Yeah, and I think that thought was in the back of folks' heads as this developed. In part, again, the committee really wants to get out ahead of regulation and kind of be self-regulation for the industry and make sure that the regulation develops in a way that's sensible, that meets needs of both investors and issuers, and is not just arbitrarily coming from a third-party source.
Very cool.
So you're flipping over just a few points on the loan level data. We seek to standardize values where we can, and you can imagine with 94 fields and many different marketplace lenders that standardization is a goal, but not necessarily a goal that can be 100% achieved. And there's flexibility allowed where needed. And loan grade, as I mentioned, many of the platforms have their own proprietary grading system, and they may or may not line up with some of the other factors like FICO. And so there's a freedom to kind of superimpose your own grading system and disclose how that system works within the wider offering document. Income verification is something that I think is, different platforms come at it from a different angle, and so we have kind of 3 different levels: income not verified, stated income, or verified. We also allow for the individual platforms to explain exactly what that means, because there are different levels of verification. Some, for example, will only verify up to the income level that's needed to approve the loan at that loan grade. Others will verify income completely. Others will underwrite off of stated income or no income if certain other qualifying factors have been met by the obligor. I don't know if you have any thoughts on that.
Yeah, I think my perspective, from SoFi's perspective, we're a frequent issuer, so we're really taking a very long-term view of this, and we want to provide data to our investors on a regular and reliable basis. I think hesitant to start getting into scores and things where people are relying upon us for, for valuing the credit in the pool. So I think, our perspective is to really provide as much data about the loan, as possible, but less so about things like, scoring.
A couple of concerns that were balanced in this approach. Obviously, obligor privacy is of the utmost importance. So there was a great care taken to not include data fields that could allow folks to reverse engineer and re-identify the individual borrowers, and that obviously is a concern that becomes more and more as big data develops. Simple things like including an obligor's state of residence, but not the zip code, was one way folks thought we could better protect privacy.
Very familiar issue to anybody who participated in the asset level data comment process through the SFIG committees.
Another one was proprietary information. I think the marketplace platforms very much feel like they do have, in some ways, proprietary underwriting models. And so, one of the things that folks, for example, did not want to disclose was origination channel, just because many platforms felt that was their secret sauce. And there was, much discussion amongst issuers and investors around whether there could be enough data to kind of allow for still a good understanding at the loan level without having to provide this field, and that was the ultimate decision that the sides came to. And I guess I touched on how these fields were developed. It very much was input from all sides. We had the full committee. We also went offline with just the issuers, where they could be a little bit more frank and kind of develop what they were comfortable doing, develop their concerns, and then that was taken to a group of investors, and there was plenty of back and forth. I don't know, Rich, you want to speak to that?
No.
Okay, fair enough. And I guess last thing I'll note that this is really still in green paper form, so eventually it will truly be a white paper, which is not just on my printer. And so the idea is to eventually, after there's review and comment on this green paper, to eventually put out a white paper and hopefully be the start of standardization within the marketplace lending asset class.
Just big picture, what is unique about disclosure and reporting issues for the marketplace lending sector?
Well, I think, contrasting it with Jack's discussion, there's not this decades of history around the asset class, and there really is not even history within a down cycle yet. And as a result, that plus the culture of many marketplace lenders as being disruptors, they're trying different things, and different criteria, different fields are important to some and not others, and vice versa. So to come up with a set of true standards in this market, especially at this stage of development, really is not possible. I think these are much more a sense of guidelines, what we've kind of aggregated from many issuers and investors as the principal fields, but there's flexibility to deviate. In some fields, issuers may choose not to include because they're not relevant. Other fields, issuers may choose to include that aren't in this screen paper.
Interesting. That sort of leads me to my next question, to which I now think I already know the answer. How likely do you think it is that we'll actually be able to achieve standardization in marketplace lending?
Well, I think there's kind of two levels of standardization.
Yeah.
I think in terms of standardized fields, that's really what this green paper is going towards, and I think that that can get pretty close.
Right.
In terms of the values added to the fields, I think different marketplace lending platforms may take different approaches, and so there'll be some explanation, and it's not going to necessarily be apples to apples across every field. The hope is, though, for the ones that we can be apples to apples, that we designate those and we come up with definitions that the industry adopts.
How do you think other asset classes might benefit from this green paper, even though it's geared towards marketplace lending?
Well, I think a couple things. I think the process by which it was developed, issuers, investors, other market participants, all kind of are rowing in the same direction on this one. I think it's a model that hopefully other asset classes will continue to work with as well, and SFIG was great at facilitating that.
What do you see as the future for marketplace lending disclosure and reporting?
Well, I do think that hopefully this green paper will become a white paper that these reporting fields will get adopted at least if not universally, at least to a strong degree, and that at the end of the day the market will present data across different issuers in a way that investors can really make good comparisons.
Awesome, thank you. Could we go to our next polling question, please? Do you find marketplace pool level performance data to be consistent across reporting platforms? 25% yes, but 75% no. That's interesting, and I think that takes us into our next topic, which is sort of practical aspects of marketplace data and reporting. We can go back to the slides now. Rich, can you tell us a little bit about real world? What's SoFi's experience in and views on addressing some of these issues that TJ's been talking about on a theoretical level?
Yeah, I mean, from my perspective, as an ABS issuer, we really kind of look at the market as it's the consumer lending market,
right?
And less so the so-called marketplace lending market. And I have some people joke about they don't want to tell their boss they actually bought a marketplace lending deal, right? It's consumer lending, right? So the word's kind of I think a little confusing for some. So I think from the perspective of the green paper. It really has done its job in some ways already because the industry I think is more mature than is implied by the need for a green paper at this point. So as much as I think it's great and we will continue to support the development and turning it into a white paper, I think that there's some the practice already is kind of at a level where just by the size of the market and people that are investing in our deals and other deals. SoFi did $13 billion in lending last year and securitized about $7 billion of it. So following the practices that are in these papers in this paper, so it's not as it's clearly not as undeveloped as perhaps the need for a paper would represent. But really very supportive of getting data out there, and so when we do a deal, we have a data room and we allow our investors to come in and take a look at the loan level data, and we think that's really important. And then from an ongoing standpoint, we're providing we really built up a good investor reporting platform, and we think that's really important. So again, it feels like it's mature already. It's certainly not the the Wild West that a marketplace lending kind of perspective might otherwise be perceived to be. So investor reporting is really important to us, and we're supporting the obvious places, which is why we asked that question about what platform are people using. So we're providing loan level data to various platforms, with the attempt to try to be as transparent as we can. And I think that leads me into one of the points of it that I wanted to make, which was why is this need for these third-party platforms? And talking to investors, some are very happy to get the data themselves, and do the work, and they have teams of people that are doing it. But increasingly, it seems that the industry is growing for this this third-party approach. And the technology's there to do it. So it seems like that's one of the things that kind of fell out of the crisis. A lot of these third-party firms that have popped up that allow you to do some really thoughtful analysis. So, for example, during the hurricanes in the fall, a lot of people were asking us questions about that, and the third-party platforms did a great job. You can literally aggregate out those loans. You can't necessarily see loan level, but you can say, show me the Harvey loans, right? And they did those types of screens, the performance of the Harvey loans, right? So that I think is a great development for this industry, that those tools are out there, and you can do things like you can build credit curves from that data by looking across years of data across the different platforms. So I think that has helped to standardize things as much as, again, the green paper had intended to do. So just by contributing to these platforms, if you want to be up on one of these platforms, you're effectively standardizing, right? Because that's what these platforms are doing, is allowing you to look at at performance across different issuers. So that's accomplished some of the needs. But ironically, that even though that helped with standardization, it also creates some discrepancies, right? And that's a bit of a problem for us as an issuer. So I'll get calls, someone will say, why does Bloomberg show, one CPR and Intex shows another, and DVO1 shows another. So, and there's technical explanations always that I can get into about why that happens.
Do you think that'll improve?
Well, I don't know if it will, because it's something, in some cases it's just the approach, and how, how each platform is doing things. And that's discouraging. But I don't know how much it matters. So if one platform says, you're at 10 CPR, and another one says you're at 12, it's annoying, and it just, again, it's the way how they're looking at it. And to the extent that these platforms put out, a white paper explaining, how they do the calculation, then you can kind of say, oh, okay, I get it. I can see why there's a difference. But it becomes an issue for us as an issuer that we have to kind of trying to keep reconcile why is one platform different than the others.
Right.
So hopefully it will get better, but I'm not sure it will. Yeah.
How do you see marketplace lending data and reporting sort of evolving in the future? You talked a little bit about third-party platforms and the changes there. Anything else?
Yeah, well, I think that seems to be that is improving in the sense that each one of these platforms cares about the asset class. For example, Bloomberg. Not to attack them, because we all love Bloomberg, but they don't do a great job with student loans. It's just not something they do well, right? But they're working on it, and they're making progress, and I'm really encouraged that will be a good source, for both data as well as analytics, in doing cash flow runs. But for now, that's not a great source, but because my viewpoint is that the industry is maturing already, it's not being neglected. So as much as I think these third-party platforms have really done a great job at helping bring people into the space, the more traditional Bloombergs of the world are being more aggressive in trying to provide better data. And Intex does a great job both from a cash flow modeling standpoint as well as a reporting perspective. So if you're looking for again, kind of the traditional, CPR, CDR losses, those types of data fields, which are very important, that is a great and reliable source. But I think the other, development, I think, is that, I think that well, for us as an issuer, we've gotten better at providing data directly to our investors as well. So I think it's really kind of up to the investor to decide what's their choice of receiving data. And I think one of the things that we'll do eventually is build a portal for our investors. And I think some of the issuers are doing it already. I think OneMain has a really good portal, and so there's definitely multiple ways to access data. And I think that the ongoing theme is make sure that your investors have access,
Which is the important thing.
Yep.
Why don't we move on to our very last topic, we'll just spend a couple of minutes on. I would be remiss in talking about it since it's the topic of our panel. Maybe we could get the last polling question up, please. In general, do investors receive sufficient information in 144A deals? Answer 1, yes, investors wouldn't buy if they didn't have enough information. No, issuers' 144A disclosures leave much to be desired. Obviously, panel accepted. And 3, the answer depends on issuer, transaction type, and asset class. I don't know how many people answered it. It seems pretty split. We can go back to the slides. I think, the one thing to just keep in mind is, theoretically at least, the SEC still has sitting out there a proposal to require public-level information in unregistered 144A deals. It's a proposal. It wasn't in the final Reg AB2 adopting release. Maybe it'll get adopted or addressed in the future at some point. Maybe it'll get ignored. Maybe it'll get officially dropped. I'm not sure that we really know right now. I just might ask a couple of questions about this. Jack, RMBS is an asset-level data class and the rules. So if we required public-level disclosures in 144A deals, would that change the market at all, do you think?
I do think so. It would certainly be a large increase of additional information that'd be available to investors. I guess my My question back on that, not to you, but just rhetorically, is I wonder how much of that would be able to be absorbed by investors. And I think, frankly, maybe the only way to find that out, obviously, it's come out of issues that we have seen actually happen pre-crisis. And so the question is, if presented with all of that additional information, are investors in a position to be able to use that information, react on it, and at least we'd know if it was presented that they'd be able to have the opportunity to do so, be presented with some information that mirrors, more information that we get when we do our analysis. Some of the information is very important. So I think it could have a change on the market. It would certainly be, additional difficulty for the market to implement, but yeah, it would be impactful.
So if we build it, will they come, really? In a way.
Well,
maybe. Okay.
Maybe.
Rich or TJ, one of the two of you. What about marketplace loans? It's one of the questions I have is they're not actually a asset class that would require asset level data. So my question about that is there a reason why we think we haven't seen a lot of any marketplace public deals yet? Any thoughts on that, either of you?
I think it's still a relatively new asset class. That just may be part of the reason. What's interesting is that you look at way back in the early days, the peer-to-peer model of Lending Club and Prosper, and those were at
That's
a loan level registered deals.
Yeah, they were. What do you think is the likelihood that the SEC will do anything about this in today's climate, if you care to venture a guess?
That, of course, it assumes that we can make sense of today's climate.
It is a climate. That's a climate.
Personally, I think that the industry, as long as it doesn't give a reason to the SEC to make regulation, and that's what this green paper and other efforts are meant to do, is to show that this industry can grow responsibly without outside regulation. That's the concern. I mean, typically regulation flows out of disaster.
We don't want that.
No.
Well, I think we're about at the end of our time. Do we have any audience questions? We have about a minute or 30 seconds. Anything? Okay, then thanks very much for coming. We really appreciate it.